last week we started learning about chapter 15, like raising capital, and our first topic was the venture capital. And I believe that I explained the popular investment sectors, and there's another information. So as you might already know, in the United States, one of the places which is the center of the venture capital is the Silicon Valley. So Silicon Valley is located in California, and Silicon Valley is named after its mines of silicons there. And the silicon is a raw material which is essential in making the semiconductors. So that's why many IT companies gather there, and because of those firms, a lot of investors also started to live surround the area. So that's why if we look at the number of funds, California is the number one among many states in the United States, and they have invested huge amount of venture capital money in among any other places. And let's look at the venture capital performance. So I explained that the venture capital is not a safe investment. It has a huge risk that if you invest in a venture firm or if you invest in a startup, most likely 90% of the companies fail. So therefore, and that can be found in this figure here. So this one shows the return, the earnings from their venture capital investment. And here this is 1x means 1 times, and this is less than 1 times. So it means, let's say if you invested $100 in a firm, then you get less than $100. For example, 90, 80, or nothing. So if you look at these black bars, 60, this one represents the number of deals, and you can see that among all total number of venture capital investment, 64% fails. They didn't even get the money they invested, so they lose the money by choosing these startups. However, you can at the same time you can see that some companies yield even 10 times larger returns, or even more than 20 times return from their investment. So these are the reasons why venture capitalists are interested in this kind of investments. They may fail, most likely. However, at the same time, there is a possibility that a single company you invested will survive, and this company will generate huge amount of money, so that you can have fun for your rest of your life. So that's why there are a lot of venture capital investment, and they are seeking high risk, high returns. Okay, so now we are moving forward. So let's say that a venture or a startup was able to have the venture capital invested, and it was able to grow, and now it is turned for the stock market. So from these sections, we are going to learn about the procedures and mechanisms of stock market to invest in these companies. And as far as I remember, I explained about the concept of the securities before. The securities are the mean or the measure of the companies to get funded. So they want money from the investors and they issue securities like bonds and the stock. And in return, investors are promised with future earnings. And one major aspect that distinguish securities from other contracts is that these are tradable. So investors can choose to sell it or choose to buy it from other investors. And that creates the demands and the supplies of these securities in the market, and these marketplaces are the stock markets. And generally in this chapter, we are going to focus on the stock rather than the bond. And there are two kinds of offerings. The sales of the securities. First, we have public offering. Which means the company wants to sell the stock to individual investors, the public investors, anonymous investors. But on the other hand, we have private offering, which means the company wants to sell the securities to some few minor but very special investors. So these small number of investors are professional, so they have a bunch of experience and they have a lot of fortune, so they don't care whether they get the money or not from this kind of investment. So, and they also have professional skills to analyze the ability of the company, so they can decide, they can make rational decisions. However, when it comes to the public offering, so it is a big deal because the company is trying to sell it to the people like us, and generally many people don't have enough abilities or skills to analyze the price of the securities. So therefore, there is a very high possibility that they will fail in this kind of investment. So the governments and the regulators try to protect the public investors from the companies. They want to make sure that these companies are not fraud. So they require the companies to have a set of financial statements and the disclosure about the existing shareholders, their future plans, and blah blah blah, in order to make sure that the investors can be confident about the future of these companies. So they require a lot of procedures. And although the companies are professional in their own industries like IT or the e-commerce or the say food or the beverages, they are not professional in this finance sector. So the securities company are there trying to help them. So they are going to be the partners of the issuing companies. And these partners are called the underwriters. So why does it called underwriters? You can see before the advent of the IT, internet, this is the traditional way of the advertisement of a company trying to sell its shares. So actually, the company that it is trying to sell at this moment is the World Wrestling Federation, WWF, the entertainment, and it is trying to sell common stock. and the price is $17 per share. And if you look below, there are some famous names: Bear Stearns, Credit Suisse, Merrill Lynch, and Wood Capital. So these are the securities company or the investment banks in terms of the United States. So these are the underwriters. And why do we call them underwriters? Because they write their name under the company's name. So they provide their signatures below, and it means they are committed to help the company to get funded. So what they do, they provide several information as well as they design the specific securities. So first, they help the companies to formulate the method to issue the securities, following the procedures provided by the regulators. And second, based on the information provided by the company, they help to set the price. So in other words, they set the price of the company, of the securities, of the stock for the investors. And third, using their network, they sell the securities to the individual investors as well as the global financial institutions. So the typical procedure is like this. The typical procedure in public offering is here. So first, a firm, a company decides that it needs to raise capital and they want to issue new stock, and they contact with investment bankers or the security firms. And a lot of investment banks and security firms come and they bargain. They want to be the partners. So they compete each other, and few selected bankers or the security firms will be the underwriters for the company. And then these underwriters get the full information about the company, what happens inside the firm, as well as the financial statements. And based on this information, they help to set the initial price of the stock. And using the information, the firm and the underwriters prepare prospectus. The prospectus is a document that is not yet finalized. However, it contains sufficient information to help the decision-making process of the investors. So it contains the financial statements, the price, the number of shares, the expected futures outcome, and the company's managers, the shareholders, and other legal things as well. And they send these prospectus to several parties. First, they send these prospectus to the regulators. In the United States, they have Securities Exchange Commission, and this authority is the supervisor of all companies in the stock market. And in Korea, we have Financial Supervisory Services, in Korean 금융감독원, and also we have Korean Exchange, 한국거래소. So the Korean companies send their documents to FSS and the Korean Exchange, and they start reviewing the documents, whether this is a fraud or not. And meanwhile, they also send the copies of the prospectus to the other security firms. For example, let's say the underwriter is Mirae Asset, then they send the prospectus to Samsung Securities, they send the securities to Daewoo Securities, not Daewoo, Kium Securities, and also some Merrill Lynch in the United States and Credit Suisse in Europe, so that they can look at these documents. And these other security firms, they them by themselves, they evaluate the performance of the firm, and they reply with their demand, what they feel and what is their opinion, and whether they have some willingness to buy the stock. And if they want to purchase, what is the desired price? So it is like having a survey so that the company and the underwriters can have the idea about how others are feeling about this prospectus. And based on this prospectus, they finalize the price. In other words, they set the final price to be sold. And meanwhile, the SEC or the FSS in Korea will complete their reviews, and if they approve, then they can go. And the firm and the underwriters will provide the final version of their prospectus to individual investors, and individual investors can apply to the company that they want to get certain shares. And based on the number of shares, these investors will get the real number of shares, and in return they are going to pay certain money, and these money will be collected by the underwriters and these money will be given to the company. So this is a typical procedure in a public offering, and as you can see, very complicated. Now let's think about the two major partners. So we have, on one hand, we have the issuing company, the company that wants to make some money from the offering. And second, on the other hand, we have underwriters, the securities firm or the investment banks. And they also make a contract because they will get the money from this kind of process. So there are different ways. If you look at the public cash offers, there are at least three kinds of types. The method. We have firm commitment, and we have also best efforts, and finally we have Dutch auction. So you can just ignore Dutch auction at this moment, but let's focus on these two. First, a more traditional and a more simple way of the underwriting is best effort underwriting. So the best efforts underwriting is the underwriting. However, here in this case, the underwriter is an agent or the broker. So it promises that it will try their best to sell the shares to the investors, but they are not certain about the outcome. And therefore, sometimes they may fail to achieve their objective. For example, let's think about a securities company and a corporation, and the offering price is set as $150 per share. So this offering price is the price that the final investors pays to the securities company. And in this process, the securities company will get the fee from the company, and this fee is $5 per share. And the company wants to have the number of shares 200 million. And we can have different scenarios, but let's focus on two. First, in the first scenario, all shares prepared are sold. However, in the second scenario, we have a failure. So only a portion, 180 million shares will be sold. And let's compare these two scenarios. First, if all shares are sold, then the total money that investors pay is $100 per share and 200 million shares. So it is $30 billion. And among the $30 billion, some belong to the underwriters, not the corporation. So actually, the corporation has to give the fees to the underwriters, $5 per share. So actually, what they get is only $29 billion. So about $1 billion will be given to the securities firm. So the securities company earn $1 billion as a compensation to be part of this deal. But in the second scenario, we can see the difference. So in this case, only 180 million shares are sold. So therefore, the total money raised is $27 billion. And the company gets $26 billion $100 million. So they compare with the previous result, they lose $2.9 billion. But however, the security company earned $900 million. So compared with the previous result, they lose $100 million. So you can see that the securities company have an incentive to sell more because they will get the pro rata underwriting fees. Whenever they sell more, they get more fees. So they have the minimum incentive to sell more. However, it is restricted. In other words, even if they fail to sell some of the shares, they may lose some money, but these are not that significant. However, a huge losses occur for the corporation because what they get is only the money from 180 million shares. So what happens to the rest 20 million shares? They are cancelled. So in this underwriting, in the best efforts underwriting, the ownership of the shares belongs to the company, the issuing company, and it is directly transferred to the investors. And therefore, the underwriters are not the owners. However, they are here to help the firm facilitate the sales. And at the same time, the responsibilities are also on the firm. So if they fail to sell some of the shares, then these are their fault, not the underwriters, because underwriters did their best effort. But these are simple mechanism, but there is a more modern version of this contract. Another way of having a contract between the issuing company and the underwriters is to have a firm commitment underwriting. And in this firm commitment underwriting, the underwriters become the principal or the dealer. So they become the owner of these shares. So in this firm commitment underwriting, the ownership is transferred from the firm to the underwriters, and then it is again transferred to the investors. So it is like the underwriters saying, hey, you don't have to worry about the results. We are going to take care of everything. So don't worry, just give the shares and you can just take a rest. And the firm doesn't have to worry about the potential outcomes because the underwriters will take the full responsibilities and they are going to promise the firm the promised money. So let's look at the example. In the previous example, let's change the situation slightly, and now they have agreed in the firm commitment underwriting, and there are two prices. First, the offering price, which is determined by the underwriters, and this price is for the investors. And second, there is a transaction between the underwriters and the corporation. For simplicity, let's assume that this is $145 per share. And again, the number of shares is in total 200 million. And think about the same scenarios. So in the first scenario, everything is perfect again, so nothing changes. So the corporation raises $29 billion as same, and the investor paid $30 billion. So the difference belongs to the securities firm, the underwriters, which is $1 billion. So nothing is different from the previous example. However, in scenario 2, now we have a modification. Now, one big difference is that even if the underwriters fail to sell all shares, still the corporation can get what they wanted because they already gave the shares to the underwriters already. So they already got what they wanted. So still the company can have $29 million, and the investors, they buy only 180 million shares, so they paid $27 billion. So it means the securities company paid 29 billion, but they get 27 from the investors. So actually, they lose the money. So they incurs the losses from this transaction. So you can see that in the best efforts underwriting, when things go well, you don't have to care about any ways. However, when things are not going well, in the case of best efforts, firm will be in trouble. But in the firm commitment underwriting, the underwriters will be in trouble. So this is about who is in charge, who is taking the responsibilities. So that makes a difference. And let's think about these two different ways of underwriting from the perspective of the underwriters. If you are working in an investment bank, and if you have your customer as an issuing company, then maybe you can suggest best efforts underwriting, or you can suggest the firm commitment underwriting. And in the firm commitment underwriting, you are responsible. You need to take the full charge, and you will be in trouble when things are not going well. Still, you may offer the firm commitment underwriting. Why? Because you have something to get more from this contract. In this firm commitment underwriting, you can incur some losses. However, at the same time, you can make huge money because now you have the total number of shares, and you can set your offering prices whatever you want. So if the investors are coming in rush, they are rushing to buy the shares from the company, then you can set higher offering prices, and by doing so, you can have a spread, and this will be your potential returns. So in the firm commitment underwritings, you have a high risk, but at the same time, you have higher chances to get more return. So therefore, in the case of the firm commitment underwriting, This means the security firm and the investment banks have some confidence about the future of the company. So they know, they expect that there will be a lot of demand, so the stock price will go high. So that's why they are suggesting firm commitment underwriting from the beginning. But on the other hand, some companies are offered with the best efforts underwriting. This means underwriters are not that interested in this company. So these underwriters feel that they have a pessimistic point of view. So if they believe that in the stock market, investors will not sufficiently try to buy the shares of this company. So that's why they are just offering this best efforts, because they don't want to take the responsibilities. So what happens in reality is that actually more than 90% of the deals are proceeded with the firm commitment underwritings, because it gives some hint about what will happen in the future. So the corporation also understands that if our company is so hot, if our company is so popular, then these underwriters will offer the firm commitment underwriting from the beginning. So if they are offered with the best efforts underwriting, they just cancel the deal. They just cancel, or they delay until they become confident about their own future. So in reality, most of the deals are in the firm commitment underwriting. And now, these are the general procedures in the public offerings, and each company can have several public offerings. For example, maybe a company will have the first public offering of its shares in 2009, and again in 2011, and again in 2015. So they can have multiple offerings. However, we often emphasize the first offering, and these are called as the name implies, initial public offerings. These are like the debut of these companies to the stock market. So this is their first time, and for everyone, the first time is so special, right? So before the initial public offering, there was no stock or the shares traded in the exchange, and there has been no record of the transaction, and the company didn't have to disclose its financial statements. So the company was concealed. So the company was hidden. However, now after the IPO, initial public offering, now anyone can become the shareholder of the company by simply purchasing one share from the stock market, and everyone can access the financial information by looking at the financial statements. So this is a very important moment, and that's why we emphasize the role of the IPO. And why the companies want to have the IPO? Because it is their first time to raise huge capital from the public investors. So before the public offerings, they can have private offerings. But the private offerings are only for wealthy individuals. So maybe you can get $1 million from a single person. However, if you have 10 people, then you can have $100,000 from each one. And if you have 100 people, then you only need $10,000 from each individual. And if you have 1,000 people, then you only need $1,000 per individual. So the number of people decide how much you can get as the result. So if you are concentrating on the accredited, professional, special individuals, your total money, your total amount of money that you can raise is limited. However, now through a public offering, you can have access to almost everyone in this planet. So this is a very huge chance for the company to have a big equity raising. And that equity capital will be used by the company for its investment. So that's why Google had its IPO in 2004, Facebook had its IPO, Amazon had IPO, and almost every company you think had their IPOs before, because they want to make big investment, and that requires a lot of money, and that can be only raised by the IPO. So that for that reason, IPO is very, very important. And on the contrary, we have seasoned equity offering. So seasoned equity offering means this is not their initial ones, but these are subsequent following raisings. However, contrary to the bright side of the IPOs, generally the seasoned equity offerings are have a dark side. We are going to have a chance to learn about the seasoned equity offering in the next chapter, but at this moment, please remember that the seasoned equity offering is bad. And the intuition is that if you go to your parent several times and please give me some money, and your parents will wonder what happened to your pocket money, right? So this is a similar thing. So this company already got the money they said enough, but they are asking the money again and again from the investors. And that means there is some trouble. They are losing a lot of money, or they are in the danger of becoming bankrupted. So that's why they are so desperate to make another offerings. So generally, seasoned equity offering companies are not. These are believed to be bad companies. So the companies, as possible as they can, they try to avoid seasoned equity offerings. And another, from the perspective of the investors, IPO is also a very big event, because if you participate in the IPO, you can earn a lot of return from your investment. So this is on the x-axis we have day, and on the y-axis the stock price. And before the D-Day, the first day of the company's debut in the stock market, there is no transaction, so we don't have the recorded price in D-2 or D-1. However, on the first day, we are going to have the price. And if we wait until the close of the market, we will find the close price. And generally, what we find is the IPO companies record higher positive returns for the first days, especially in the first day, very first day. So generally the stock prices increases over time statistically. And if we compare this close price with another, we can compare this with another price, which is the offering price. So you need to be very precise about the meaning of the price. Here, the meaning of the offering price, this is a transaction between the underwriter and the initial investor who get the share. But the close price, this is the transaction between the investors and other investors. So that's why we need to concentrate on this offering price. And what we find is in Korea, if you are lucky enough to get the offered shares from the company, then statistically, on average, you have at least 60% return from getting the shares and wait only a single day. So at the end of the day, in the first day, you can sell it at a 60% higher price. For example, if the offering price was $100, then generally speaking, the close price will be likely to become $160. So you get $60 as the profit. So that's why investors are they feel that the IPO is so special and they want to participate in this process. Then let's think about this phenomenon from the other perspective. So from the issuing company's perspective, the closing prices or the subsequent prices, these have nothing to do with the company because the shares are already in the hand of the investors, and these are the trades between the investors. What is important for the issuing company is the offering price, because this is a transaction between the underwriters and the initial investors, and this will decide how much money the company can get from the IPO and how much capital the company can accumulate. So this is more important. And in the first day, usually the company managers found themselves unsatisfied or feel unhappy because they sold their shares at a lower prices, but eventually it was found that the share price can go up even 60% higher. So they will feel that they were betrayed by the underwriters, because underwriters could have sold the shares at a higher prices, but they sold at a lower prices. So that's why we call this phenomenon as IPO underpricing. So from the perspective of this price is underpriced. And here is a statistical result. So in the United States, if we aggregate the all IPOs from 1960 to 2019, average first day return is 17%. And if you just invest in the stock that is already on the stock market, annual return is 17% or 13%. So if you have to wait for almost 1 year to get the same return. However, this return is only possible in a single day. So this is a very profitable investment. And there are other statistics for the countries around the world, and Korea is here. This is not an exception for the European countries as well. For example, France, 10% first day return, Germany, 23%, and Italy, 15%. And in Korea, this is even higher. Korea has a first day return average 58.8%. So it means the stock price becomes almost 50% higher. So if you participate in the IPO process, then you can make a lot of money. Then why there is this kind of phenomenon of the underpricing? So there are several reasons, but I'd like to provide you with two alternative stories. First story is about the information. So we are going to learn that the pricing or the valuation is very difficult, and this valuation is possible through the information. If you have information enough, you can have the price. However, the problem for the IPO companies is that there is no prior record. There is no information before the IPO. So investors are afraid. Investors have no information that they can rely on, so they are just hesitating to participate in this IPO process. So underwriters need to bargain. They need to have a promotion by setting lower offering prices. Otherwise, investors will not participate in the IPO, and therefore the IPO will fail and underwriters will lose a lot of money. So that is the first explanation. And there is a backup supporting evidence. So it means when we have more information, then we will have less underpricing. And when we have less information, we will have more underpricing. And actually, the statistics show the same result. So this is a sorting of the IPO companies based on their sales. And we have a smaller companies and we have a larger companies below. And generally, we can say that larger companies have more information, but smaller companies are opaque. Smaller companies are provide less information, and the initial returns are higher generally for the smaller companies, and the initial returns are smaller for the larger companies. This provides the explanation that larger companies has more information, so they have smaller underpricing. Smaller companies have less information, so they have larger, higher underpricing. However, there is another story. Another story is a game between two partners. We have the issuing company and the underwriters. So, from the perspective of the firms, they want to get more from this IPO. So they want to have higher offering prices. But on the other hand, underwriters, they want to get the shares from the firm at a lower prices, because by doing so, they can make more profit. So there is a bargaining game between these two parties. The firm wants to set higher prices and the underwriters wants to set lower prices. And generally, on average, underwriters are powerful because firms, they don't have enough experience of what happens in the stock market. So they need to rely on the financial professions. And underwriters have sufficient information because they have their network and they can sell the shares through their networks. So they are more powerful. So what happens in generally is that they set the price lower, and by doing so, the firms lose some of the money that they should have raised. And the same statistics can be used to support this idea. So which companies will be more powerful? Larger companies with a lot of revenues will be more powerful. However, smaller companies will be weaker. So the weaker companies, smaller companies are weak, so they just allow the underwriters to set the offering prices whatever they want, and they have a higher underpricing. But on the other hand, larger companies have enough power to decide their own offering prices, so they have smaller or lower underpricing phenomenon. And the extreme case is the Google. And when I talked about the firm commitment underwriting and the best efforts underwriting, I slightly mentioned there is a third way of Dutch auction. So in 2004, Google had its IPO. And Google at the time, Google was so powerful already because everyone knew that the Google will become very, very large conglomerate in the future. So a lot of investment banks, they wanted to become the underwriters for the Google. However, the Google founders, Larry Page and Sergey Brin, they had different ideas. They thought that the typical IPO process involves the underwriter's profit, and they wanted to minimize this influence. So they just had the auction so that every investment banks, every security firms, they have to compete each other. So the highest bidder can get the shares of the Google. So by doing so, they were able to cut the underpricing phenomenon. So this was only possible because Google was so powerful game player. And this is an extreme case, but generally what happens is that we have underpricing, so the company had to lose some of the money that they should have got from the IPO process. Okay. So from the last week to today, I talked about a general description about raising capital, particularly with the attention to the stock market. And as we talked in this brief, there is on the pricing, and this is very difficult to evaluate the stock price. And so in Wednesday, we are going to have a chance to learn about the valuation. This is some of the procedures is that we already discussed during our case study or in the class. but we are going to have more flavors so that you can be prepared for the next case study. And before we move on, I'd like to explain about the structure. So there are a range of methods to evaluate the company's stock price. However, we can classify them into two categories. First, this is not a global term. Maybe it will be applied in Korean. However, generally speaking, we have absolute, so-called absolute valuation, and we have relative valuation. So this is similar to the evaluation of the students when I grade. So typical university students are graded relatively. It means based on the peer performance, your final grades will be determined. So if other students have higher midterm exam results, then you are going to get lower grades. But on the other hand, if other students, the average is low, then you are going to get A+. So this is the relative valuation. So in this valuation method, the company will be compared with its competitors. And by comparing it with its peer group, we can imagine what will be the price for the company. But on the other hand, we may need to evaluate each student independent from others' performance. So that's called the absolute way of valuation. And this is actually a different name of the discount cash flow valuation. So in this valuation method, we concentrate, without looking at others, we concentrate on the company itself. Then we look at the future cash flows generated by the company, and based on these cash flows, we calculate the present value of the company. So these two methods are complementary to each other. So it is not sufficient to know only this one or this one. You need to understand the both ways in order to make a more rational decisions in the valuation method.